Hello, I'm Richard Hunter, Head of Markets, and welcome to our look ahead for the week commencing the 17th of February. We can expect volatility to continue, particularly as the new president continues on his various decisions around tariffs. In terms of this week, markets have just about kept their heads above water in the absence of any more specific detail, but this is something that will continue to overhang markets, and you can expect to see some intraday volatility as and when new announcements come round. That being said, and quite apart from any inflationary impact which tariffs could have, that last mile is proving to be tricky on both sides of the pond in getting inflation down to its 2% target, although that being said, of course, it is at least slowing down its ascent. Meanwhile, this is all going on, the volatility has apparently attracted some investors into the relative haven of the FTSE 100, which continues to test new record highs and has had a very good start to the year. So in the year to date, the Dow Jones in the States is currently up by 5.1%, the S&P 500 by 4%, the Nasdaq by 3.3%, and maintaining its early lead, the FTSE 100 is up so far this year by 7%. Turning to next week, it's all about banks, left, right and centre. In terms of this week, we had some pretty good numbers, both from Barclays and NatWest, although the share price reactions didn't necessarily reflect that, partly because there were no particular upgrades to guidance which punched out the lights, but also because both of the shares had doubled over the previous year. So that's something to bear in mind for next week. The three remaining UK banks will be reporting, such as Lloyds. Lloyds shares are up about 56% over the last year. And of course, it's seen as something of a UK barometer, which can work in its favour, but also against it. So keep an eye out there for any potential credit impairments and bad debt provisions. It'll be interesting to see also whether it mirrors what we've heard from Barclays and NatWest, namely that the overall yearly numbers were flattered by a strong fourth quarter. So that's another thing to keep an eye out for, as indeed will be its cost-to-income ratio, which is usually sector leading, but it's been under a bit of pressure recently, partly because of the cost of its ongoing branch closures. Also, full year numbers from HSBC, shares up 43% over the last year. Rather more of a sprawling geographical giant, this one, of course. It's transformed its business into four key areas now, so strategically we'll hear no doubt if there's any update on that. And it's also targeting the affluent wealth sector, so growth numbers there will be of interest, as indeed will its exposure to markets generally be within its global banking and markets division. We've already seen that not only the US banks but also Barclays have had the benefit over recent months. And again with HSBC, credit impairments, particularly with regard to its exposure to China. Finally, Standard Chartered shares up 93% over the last year. Again, it has a markets trading unit, so that's one to keep an eye out on. It's also got that exposure to China, although in terms of that affluent wealth, it had been previously doing well. Another large economy where it's seeing growth in affluent wealth numbers is India, so that's another one to keep an eye out for. And its wealth solutions business generally has been something of a jewel in the crown. For all three of the banks, of course, underlying that will be a particular interest on shareholder returns, both in terms of buybacks, but also, of course, any increases to what are, generally speaking, fairly generous dividend yields. Thank you for watching. Have a great week.